Hello everybody, this is Lara with your end of the week video for the S&P 500 for the trading week ending Friday 9th of April 2021. I do apologise for all of the rain in the background. There really is nothing I can do about the weather, and I would much rather get this out for you tonight than wait till tomorrow morning. My Elliott Wave count for the S&P has long been very bullish, and a comment a member made this week in comments after I said that I felt I was being a little bit affected by YouTube comments in a rather negative way, and I wasn't going to calculate those very high targets, which I may otherwise have done. He said, just calculate your targets. So that's exactly what I've done this week for you. I've got some pretty high targets for us to look at, and that's why I've decided to get that done. It's not because of what price is doing, it was what that member said. So my short-term target is now at 4276. Along the way, I'm expecting either 1 to 3 more little pullbacks that should be over within a day or two along the way up toward that target, either 1 or 3 little pullbacks. My midterm targets are either 4464 or 4922. About one of those targets, the next multi-week pullback or consolidation may develop. This Elliott Wave analysis is very bullish, and it has quite a lot of support from classic technical analysis. I also took some time today before I published this analysis to go over the middle and the end of the dot-com boom up to the high in 2000 for the S&P, and have a look at how RSI and ADX behaved. This bull market, these charts have an overall look of a bull market in a relatively early and possibly quite sustainable stage. RSI can reach a very overbought. It can remain there actually for years and exhibit multiple bearish divergence before a bull market ends. So if you want to know what I mean, have a look at those charts up to the 2000 high from 1994 to 2000. Really interesting. This Elliott Wave count is very bullish, and it expects a fifth wave at cycle degree began here, which should last from 1 to several years, and I'm expecting several years is more likely than not. It could last, when I say several, it could be 7, 8, 9, 10 years, and I'm expecting toward about 2028, 2029, we may possibly start to see the end of cycle wave 5. In Elliott Wave terms, it would most likely subdivide as an impulse. The only other Elliott Wave structure it can be is an ending diagonal. They're not particularly common. I'm labelling this so far as an impulse, but if we start to see some huge overlapping, then I will consider the less common diagonal. So far, primary 1 and 2 could be complete. I also have another weekly chart which moves the degree of labelling here down 1, so that's extremely bullish, even more bullish than this chart. But let's consider if primary 1 and 2 are complete, then the middle of the bull market may have begun here and may have just recently passed through its middle. That labelling could be a bit premature though. If I'm wrong, I'm too conservative and I'm not expecting as much strong upward movement as we could be getting. Look out for any surprises at this stage, particularly to be to the upside. Primary 3 beginning here may only subdivide as an impulse. Intermediate waves 1 and 2 may be complete. Intermediate 3 may have begun here. Again, it may only subdivide as an impulse. 1, 2, 3 may be nearing completion in coming days, and then 4, 5 to complete intermediate 3. Eventually, when it arrives, primary 4 may not move into primary wave 1 price territory below the invalidation point, which will probably remain the same for quite a long time. This best fit weekly channel is drawn from the high of primary 1 to the high of intermediate wave 1. This week, price is closed above it. If we look at this other Elliott channel from minor 1 to minor 3 on this weekly chart here, a copy on minor 2, and we look at this really closely at the hourly chart level, price closed above it on Friday. So price is now moving up quite strongly. Now it's closed above resistance at this trend line and this trend line. We may now see some energy released and an increase in upward momentum. May be expected. We may also see a curve and a backtest of support before moving up and away. Would also be pretty typical behavior of price. That curve and backtest may come in several sessions. It doesn't always happen straight away. Sometimes it takes a bit of time for that to develop. Let's take a look at the daily chart. We're going to look at it from this low now down here This point down here, here's the end of intermediate 1, here's intermediate 2, which subdivides at the hourly chart level perfectly as a triple zigzag, so that's how I'm going to label it. These are not particularly common structures, but they're not very rare, not like running flats. In my research and analysis over the years, I have seen a handful of triple zigzags, and if the subdivisions fit, that's how I'm going to label it. Intermediate 2 over here, intermediate 3 beginning with minor 1 and 2 complete. Minor 2 a very common double zigzag. Minor 3 may have begun here. This first target for minor 3 to reach 1.618, the length of 1, is now getting a little bit closer. About this target, we may expect a pullback or consolidation for minor 4 to last maybe 1, maybe 2 weeks, and then continuing upward movement to end intermediate 3. Minor 5 to end intermediate 3 could show a further increase in upward momentum. Every now and then, the S&P may behave a bit like a commodity and exhibit swift, strong fifth waves when it ends third wave impulses 1 degree higher, and this is a fifth wave at minor degree to end a third wave at intermediate degree. That's 1 degree higher. I have 2 targets now for the end of intermediate 3 for it to reach equality in length with 1. You've seen this one for a long time. I'm now calculating my preferred target for intermediate 3 to reach 1.618, the length of intermediate 1. I also have a new target for primary 3. The first target for intermediate 3 works with the first target for primary 3. The second target for intermediate 3 works with the second target for primary 3. The first targets are for the third waves to reach equality in length with their respective first waves. The second targets are for the third waves to reach 1.618, the length of the first wave. And so I say the second targets would be my preferred targets because this exhibits a more common Elliott Wave relationship or Fibonacci ratio between Elliott Waves 1 and 3. For 3 to be 1.618, the length of 1 for this particular market with its strong bullish bias is more common. Minor wave 4, when it arrives in coming days or maybe even weeks, may not move into minor wave 1 price territory. I expect this invalidation point at the daily chart level will remain the same for quite some time. Here's the upper edge of that beige Elliott channel, which I've drawn from 1 off to the left of the chart. You can see where that is at the weekly chart level, to 3, placed a copy on 2. Friday, if we look at this at the hourly chart level, if you copy that over to the hourly chart, Friday's just closed above that trend line, although at the daily chart level on a semi-log scale, it looks like it's right at that trend line. So if we get on Monday a clearer close at the daily chart level above this trend line, I'm going to have more confidence that we're going to possibly see an increase in upward momentum from here. First hourly chart sees minor 2 over here, minor 3 complete with minute 1, 2, a very extended minute 3 with minuet 1, 2, subminuet 1, 2, micro 1, 2, micro 3, 4, now moving toward the end of subminuet 3, and then we'll have subminuet 4, minuet 4, minute 4, 1, 2, 3 more little pullbacks, each of them possibly over within a session or maybe lasting maybe up to 2 sessions absolute max, but most likely over within a session along the way up toward this target. Minute wave 4, when it arrives, may not move into minute wave 1 price territory. Here's that close above the upper edge of that beige Elliott channel I talked about at the daily and weekly chart level. It's a close above it when the hourly chart is drawn on an arithmetic scale, but my daily and weekly charts are drawn on a semi-log scale, and it makes a little bit of a difference to exactly how these trend lines sit. So that's another reason why I say I want to see a clearer close on my daily chart with price above the beige channel before I have that real confidence that we could very well see quite an increase in upward momentum, a release of energy after price breaks through resistance. Targets are the same as at the daily chart level. There's another way to label this, well, there's more than 2 ways, but I'm going to present for you 2 from this low here, this point down here. 1, 2 is the same, 1, 2, 1, 2, 1, 2, all the same, moving toward 3, 4, micro degree in here, 3, 4 at subminuet degree here, 3, 4 at minuet degree here, and now an extending minuet wave 5. And so only one more little pullback along the way to complete minor 3 up toward this target may be required for minute wave 4. So this wave count expects more of a clear run back up to, or not back, but up to this target. That is entirely possible, and I want to always try and present alternates for you. At the weekly chart level, this is a very bullish wave count. If we move the degree of labelling here down 1 degree, and intermediate wave 1 lasting this long for this market is absolutely acceptable. This market has a strong bullish bias, and so it's possible only intermediate wave 1 was over here, and this is intermediate 2, that primary wave 1 within cycle 5 is incomplete, and if cycle 5 is not going to end until 2028, 2029, then this is entirely a reasonable wave count. When primary wave 1 is complete, primary wave 2 may then begin, which would possibly be a multi-week to multi-month pullback or consolidation, and could actually even be deep. It could technically even meet the definition of a bear market. It could even be over 20% total drawdown of total value of the S&P at that stage. We're not there yet though. We still need to see the impulse for primary wave 1 a complete structure. This wave count has it still moving through the middle of a third wave at 2 reasonable degrees, so still expecting an increase in upward momentum is entirely reasonable. Intermediate 4 may not move into intermediate wave 1 price territory. At this stage, this upward movement has a normal look of a healthy and sustainable bull market with one caveat: volume. And if you look back at the entirety of this bull market beginning March 2009, and all of that upward movement interspersed by relatively brief, relatively shallow bear markets, but overall that big bullish move, and you look at the bullish parts of that move, it has actually come with declining volume. All of the textbooks tell us that that's not sustainable, but it's been sustained for over 10 years. It's highly unusual for this market, but if we put that into Elliott Wave context, seeing it as a fifth wave at cycle degree to end a fifth wave at super cycle degree, it absolutely makes sense. What all of that means is, if we see declining volume with rising price, I am not going to expect that means price has to stop rising, because it obviously hasn't done that for over a decade. So in current market conditions, a decline in volume is not of a concern. We had that last week. This upward week came with declining volume. This week though, we have a little bit of an increase in volume, which in current market conditions is actually pretty impressive. So this is quite a strong bullish week. We also have a bullish signal from on balance volume. RSI is now just touching overbought, just. If you look back at the market that preceded the dot-com crash, the bull market up to the 2000 high, you will see that for the S&P, RSI can reach deeply overbought, and then it can exhibit bearish divergence for years before the bull market ends. Just because we have bearish divergence, it was stronger back here, it's getting weaker and weaker. Just because it's between this point here and the current point doesn't mean upward movement has to end. I keep saying that, and price keeps rising. So I'm not going to see this as bearish divergence from here. I'm going to look for a new development of bearish divergence before I expect a bigger consolidation or pullback. So I'm going to expect price to continue up, RSI to reach more overbought, and then a little pullback, price to make new highs, and RSI to make a lower high. And we'll see swing highs, bearish divergence, exactly like we saw back here. Price moves higher, RSI fails to confirm those highs, and then we see a bearish movement. We don't have that set up yet. That hasn't even begun to develop. That's a long way off. ADX is increasing, again telling us there's an upward trend. The positive DX line is above the negative. MACD is bullish. ATR is overall flat, which normally declines as price rises for this market. So for it to be flat, it's actually reasonably impressive. There is nothing at this point in this chart which tells me this upward movement has to end. And indeed, if we get to the daily chart and we now bring in the moving averages, the 200-day moving average is now below. We can't see it. Price is well above it. The short is above the mid, is above the long. They are all positively sloped. This is a full bore bullish look. At the daily chart level, ADX also is giving us a strong bullish signal. It's bullish at weekly and daily chart level. RSI is only just overbought at both of these time frames. There is nothing in this chart telling me upward movement has to end. This bullish move is not yet extreme. ADX is not extreme. RSI is not extreme. There is plenty of room to go before it may come to an end. Overall volume is declining, and I've explained the situation with that. That can actually be sustained for quite a long period of time. At the daily chart level, ATR falling with price rising is absolutely normal behaviour for this market. It is not necessarily bearish. Volatility declines in a bullish market for the indices, and it increases in a bearish market. On balance, volume at the daily chart level also gives us a bullish signal. MACD is full bore bullish. Stochastics is overbought, but that can remain extreme for a long period of time. We do not use stochastics in a trending market. We use it in a consolidating market. Let's take a look at breadth and volatility to round out the picture this week for the S&P. A strong upward week, a strong close, very near highs, with an increase in the AD line. If we break this down though and we look at small, mid and large caps, it's only large caps this week which is making new all-time highs. Small and mid caps are lagging. That's okay. I'm expecting for the Elliott Wave count that this is nearing possibly the end of a third wave at minor degree, and I would expect to start to see some little touch of underlying weakness toward the end of that. It may just be starting to develop. It does not mean we can't see another 1, 2, 3 or 4 upward weeks or more. It just means that there's just a little bit of a beginning warning underlying there. But the AD line is still making new all-time highs. When I expect a multi-week pullback, I would expect to see prior to that some bearish divergence between price and the AD line. That is not evident yet. Nor is it at the daily chart level. New highs on Friday, new highs from the AD line and price. Upward movement, despite large caps leading, still has support from rising market breadth. Between price and inverted VIX, though, there is more than 3 years of bearish divergence. Here's the midterm bearish divergence, and there is further off to the left of the chart, back to, I think, October 2007 was the all-time high for inverted VIX. Inverted VIX is not making corresponding new highs with price. It's proving to be particularly hopeless as a timing tool, so it may develop further as this bull market matures before it eventually one day comes to an end. For the very short term, though, this week VIX has declined as price has risen, which is a normal behaviour between the two, but VVIX has increased. The volatility of VIX has increased this week, even though price moved strongly higher. This is a single week instance of bearish divergence between VIX and VVIX. It's bearish for price. For Friday, price moved strongly higher. Inverted VIX also moved strongly higher. Upward movement for Friday's session comes with a normal decline in VIX. VIX has declined, but for Thursday and Friday, VVIX, volatility of VIX, has increased. With the volatility of VIX increasing for those two sessions, that's bearish for price for the short term. But I don't give this as much weight as I give the AD line. The AD line is much more reliable in my experience over the years. I'm so sorry, that concludes my analysis for the S&P 500 for you this week, and I hope that all of our members are having an absolutely fabulous weekend.